ask you, do you think you're an aggressive investor or are you a very conservative investor? You personally.
Me personally, I'm very comfortable with market risk. So very comfortable with stock market and investing that way.
We both have run into clients several times that have the exact opposite feel of the market. There's a lot of fear out there. There's a lot of concern about geopolitical issues or market issues or just anything that's jumping around that really drives someone to the other end of the spectrum. And they're very conservative based off of fear, based off of emotions. Let's stick with that. How do you approach someone who's coming to you and they'd like to become a client, but that's how they feel about the market? How do we address that? And how do we try to provide comfort that actually is helping them get through these things, but also helps them to maybe right side their portfolio, to a point. Maybe they're uber conservative and there are a lot of cash in their accounts and a lot of very conservative investments. It doesn't really meet their objectives on their plan. And if they don't kick it up a notch, their plan's not going to work. So, we as a fiduciary, it's in their best interest to try to do what we can do, for them with their investments. So how do you approach somebody like that when they come to you?
Sure. So a few thoughts. I'm going to start with the last piece you mentioned, which is their plan, the financial plan. So that's the very first thing we do for all clients is understand where they are, the assets they have, their cash flow situation, both now and projected into the future. And that's a critical place to start because what we don't lead with is asking clients what you asked me, which is how much risk do you have?
What do you invest in?
Correct. Yeah. It's really first, let's understand how much risk do they need to take to meet their goals? Because oftentimes what many clients will find is that they're in a great position. And so they may not need to take excessive risk. Now that doesn't mean stick the money under the mattress, but it means a moderate portfolio allocation is perfectly fine. Moderate meaning a mix of stocks and bonds in some weighted fashion. And so how much risk do they need to maintain their lifestyle and then to meet the goals that if they're comfortable with that lifestyle, what else would they like to take on? What do they need to take from a risk perspective? So that's number one. From there, as you said, sometimes people are in the position, have put themselves in the position of not needing to take a lot of risk. And then from there, it's up to them if they want to expand that. And we talk about the pros and cons, but let's take the other side of that coin, which is, okay, what risk do we need to take in order to make sure that we can enjoy retirement, that we can support the causes, family, other things that we want to do, and make the most of the asset base that we have. And so to that, it's really understanding, okay, this is where we're trending with the current level of investment risk that we have. How do we improve that expected outcome? And so once we know that a risk profile should look like, let's say 70% stocks and 30% bonds, for example, implementing that and talking with clients about, okay, what does that risk look like? And so a few ways that we think about that. Number one, as we've talked about, is cash planning. So making sure that clients are well positioned to cover expected costs in the near term, as well as a reasonable expectation of unexpected costs that in a rainy day emergency fund. The reason that it's important to start there is to know that really everything above and beyond that, we know markets are volatile. We know that is inevitable, that markets cycle, and that's part of the risk and expected return. If markets didn't have risk, the expected return would be far lower. They would be treasuries at that point. And so knowing and embracing that volatility to say, if we do not expect to need to utilize these excess assets over the cash need, try to get clients comfortable that there will be volatility. We plan through that up front. We're very clear that market cycle, there are recessions, there are downturns. Get people very comfortable with that up front and know that this is long-term investing. And so our pitch is never that we're timing it just right and you're going to make X% over the next month or the next year. It's positioning ourselves for long-term growth. So that's really the starting point. Beyond that, it's again setting reasonable expectations. So again, the broadly diversified long-term approach, nobody gets rich quick. This is not a scheme or a strategy that
Sure.
produces those returns. We're looking for a more steady, predictable, long-term compounding. Let's embrace the benefit of compound growth.
Right. So slow and steady can win the race.
That's
basically.
right. It does win the race.
Right. It does win the race. Exactly. So when you're looking at a person and you're having that conversation and they're uber conservative, and they have that cash position that and they're just really worried about the markets. Do you ever cite any studies or any historical numbers or anything like that you pull out of your wallet, to talk about as far as like, hey, well, this kind of history piece has really shown us that the markets have performed overall this way. I mean, how do you use more of an academic approach to describe what we do, and hopefully that is an effort to make them feel better?
Sure. So again, I'll go back first to that financial plan. So we'll put together their planning with a Monte Carlo analysis, which takes into account their specific asset allocation or the proposed asset allocation, and it's in terms of percentages. And so there are no guarantees in investing, and so really it's about positioning clients to have the best expected outcome, the highest odds of achieving what they want. And so in that, it's factoring in not only market downturns, but actually long-term historic underperformance, and that is part of the simulation that it's analyzing. So helping from a data, evidence-based perspective of here's what the numbers show us.
Sure.
That's one piece. Another piece is asking clients to tell us more about what their concerns are. Have they had prior experiences that they were invested in 2008 and 2009 or at other periods of time? Leaning into better understanding what is causing that concern. It's not trying to solve for the concern. It's trying to understand what happened, what's leading to it, and if it was a real event that happened, what was their reaction to it? That's often more telling about a client's risk profile than simply asking. Many people will say they're comfortable with risk, and then the question is, well, if the market dropped 40%, what would you do? Or
Right.
what did you do if you were an investor through a period like that?
Right.
And so that's a critical data point to us. So again, we go back to people maybe in a position that they think they're comfortable taking risk, but it's helping them understand, well, okay, every so often, to your point of pulling out kind of past facts, markets pull back 10% almost every year at some point mid-year. Not always a down year, but at some point during the year, about 10%. Drops 20% every X number of years, 30%, 40%. And these plans, especially thinking of that long-term horizon, most investors will experience these significant downturns multiple times throughout their investment life. And so it's helping investors understand this is a near certainty, not an if this happens, and providing them the comfort that this is part of the plan. We don't know when it's going to happen. We don't know the magnitude. We certainly don't know the top of the market and the bottom. Nobody can know that.
Of course.
But going into it eyes wide open, and this is all part of what we're planning for to help make sure that you're on the trajectory you want.
And just for those few that might not understand Monte Carlo, we're not talking about my dad's 1978 vehicle or somewhere in Las Vegas. Explain it a little bit. How does a Monte Carlo evaluate someone's portfolio?
Yeah, so a Monte Carlo analysis is a statistical analysis that looks at historical, it's based on probability, and that data that goes in is based on historical market returns. So markets average over time, equities 9 to 10% historically is the average. Rarely do they fall in that 9 to 10% window. There's a wide range of outcomes. Markets have had pullbacks of 40 to 50%, and they've had years to the positive of even greater. So a very wide range and everywhere in between. And so what a Monte Carlo analysis looks at is looking at that historical data, looking at, to get into statistics, a standard deviation, which is really just how broad kind of a normalized range is, so that down 40 or 50% may happen rarely, as opposed to somewhere closer to the average is going to happen more often. So that analysis looks at not only any given year, what is my probability, but again, over the course of 1,000 different simulations on a repeated basis through an investor's life, what is the probability they're positioned for success.
Sure. And that's a really good tool also to kind of point in the direction for things to implement. For instance, I know that maybe we roughly want to see around an 80% probability of success. If it's higher or lower, if somebody's probability of success comes in at 95, just tell me what you're going to tell the client. What is that telling us to their portfolio?
Yeah. But it's great to see success starting off if we assess a client's base case or we've been working with them for a while and they're at a 95% probability. What that tells us is, first and foremost, they're in a great position. They should feel extremely confident in their supporting their current lifestyle and the goals that they've shared with us that we've modeled out. That's number one. Number two, it's telling us there's really opportunity to do several things, but two of which I'll call out. One is perhaps reduce the risk that they have in their portfolio. So if they've been accumulating assets, they've had good returns, they've really put themselves in a strong position, they may be able to take that 95% up by reducing the risk. Now, there's a direct risk and return are related, so the less risk we take, the lower the expected growth of the portfolio. But sometimes what we find is that actually enhances the probability of success. And that is because if for sake of argument, if we know a client has enough assets, they don't necessarily need growth. And so dialing back the risk can help increase their probability. Opposite also on the table, when somebody's at 95%, they have opportunity to support causes that they want to support in a greater way. So that may be helping out their children, their heirs. It may be supporting charitable causes, other things that are important to them. It may simply be just making the most out of life and enjoying things a bit more. And so a lot of times the best use of that when you think about spending and consumption, enjoyment, is anytime clients can really lean into that. It's really fun when clients say, I took my entire family on a cruise this year. Or I did this trip. What's great about that is it's empowering people to enjoy feeling confident in making decisions, and really that's my favorite part of our job is helping clients feel empowered. They may know that their portfolio statement says this, but what does that mean? How do they feel comfortable enjoying it? And another example is helping set up the next generation, whether that's gifting or helping fund other things, and knowing I can confidently. It's not about leaving the most money when I pass away. I'd like to be here to see it to help my kids or grandkids.
Yeah. Those are fun conversations to have when it's in that direction, 100%. And there's so many opportunities to be able to do. That's a conversation for another day as far as like any kind of gifting strategies. But those are things that I think that when you partner with a firm like us or any other firm out there that does what we do, when you partner with Plancorp, though, those are the opportunities that you get in front of you that you wouldn't maybe really get if you're doing it on your own. Because I love the saying that sometimes you just don't know what you don't know. And I say it all the time, and I'm sure I make people sick of hearing me say it. But at the end of the day, it's a good saying because it really is true. When you're doing something on your own, you miss some of these opportunities. You might have some online tools that you can use and create a plan on your own. There's some tools out there, yes, but to really get that sharp of an edge, to really figure out, here's where I can do, here's some legacy planning that you can do, here's some estate planning that you've never thought of, and those opportunities I think are awesome. On the flip of it, let's say that probability score is low, then where does that point us? That points us that things need to be fixed, increased at some, or something needs to happen. So how do you address those?
Sure. So that's a common reality as well, is that adjustments need to be made. And so those adjustments can be really across the board. And sometimes it's small combinations of many things, no different than improving your health. It's not just working out. It's not just improving diet. It's sleeping better, doing all of the pieces in some degree. And so this is no different. So we really talk with clients, help them understand this is the reality of where we are today. We're going to work together to make sure that you are on track and stay on track. And so the ways to do that, again, number one, we talked about just compiling data and understanding the facts. That's an eye-opening piece for many, that people may have no idea where they honestly stand. You may know what your investment statement says. It's hard to know what that translates to. So number one is let's paint a real picture of where we stand, and then think about, okay, well, if we're confident that this is the facts and here's where we stand, what are those levers we can adjust? So we've talked about investing, so dialing up or down the investment allocation, perhaps needing to take on more risk to meet some of these goals. That can be one avenue. Setting up savings targets, so helping automate savings, so paying yourself first. There's a lot of people that subscribe to that theory. So setting up 401ks or contributions out of the paycheck. How do we mimic that to say, okay, I'm now going to direct on a monthly basis an automated transfer into an investment account? Because for many people, it's simply putting the money aside and investing it before I have a chance to spend it. So getting that in order, being realistic. So what can somebody save, in helping them assess that? And then modeling out, well, what are some alternatives? For some, that might mean, okay, adjusting a target retirement date, being realistic about that to help them plan into that rather than get to retirement, leave their job, and start working with an advisor and say, oh, this is not the outcome that I'm looking for.
Right.
So being proactive. Many people, that might mean not that you have to keep working a full-time role, but maybe it's assessing, is there something I enjoy doing? Perhaps it pays less than what I'm doing full-time, but I could do this for longer because I enjoy it. Expenses, probably the least fun one to adjust, but sometimes the reality, hey, are there discretionary expenses that are nice to have, but I value them less than I value my time and may want to be able to retire, but I'm willing to forego this membership or this cost. So establishing those. And then really also, I think it's painting the thing that's nice about a Monte Carlo analysis and talking about it as a percentage. Our target, as you mentioned, we want clients, we feel comfortable if clients are 80% or better. The reality is there's no black and white of all or nothing.
Right.
It is the reality of the world is that it's going to be probability and how likely is it. And so some of the time, frankly, it's helping clients understand if you're at 75%, that's a little bit below where we'd like to see.
Right.
This is not a doomsday scenario. You're in a solid position.
Right.
It's being aware that there may be adjustments down the road that you need to make. And so that's often
It's like your golf club. You got a sweet spot. You got.
That's right.
Right.
That's right.
For those that are listening right now, it's like if you did have interest in meeting one of us and having these deeper conversations, it's pretty easy to do, right? We just book a discovery call. We book a call, just have a quick conversation over the phone, or even a meeting in person, and talk about these things. I mean, there's no commitment, and there's definitely no sales pressure here ever. It's a professional perspective. You just see what we can do, and if maybe we're a good fit. So I think that's a great opportunity for anyone out there right now. If they're thinking about it, definitely contact Plancorp.
Absolutely. We'd love to talk.
We'd love to talk.